Okay. Well, good morning, everyone. It's good to be with you again. Today, I'm going to cover some year-end tax and accounting issues related to your loan, as well as a recent development in the last few weeks. We've been waiting for a long time for guidance from the SBA on how they're going to evaluate your good faith certification. And so they came out with something called a loan necessity questionnaire. So we're going to cover both of those things. Quick disclaimer, I can't reiterate enough how important it is to, whatever you're going to decide to do with any of these loans, be in touch with your advisors, and particularly your bank. They are closer to the SBA than any of your advisors, and that they have a, they get information from them. So make sure whatever decision you're making with your advisors, make sure your bank is part of that. All right. So a bit of news first before we get into some of the materials. Just a heads up, there's a Wall Street Journal article on November 5th that a judge has ordered that the names and amounts of every PPP borrower are going to be disclosed. So prior to this, they disclose borrowers in sort of buckets of loans between 150,000 and 10 million in various tranches. So they didn't really say how much a particular company got, just what category they were in, whether they were above a certain amount or between a certain amount. Well, that's all changed. So your loan amount and your company's name is going to be published, and it's required to be done by November 19th. Obviously, I don't think a good thing, especially for private companies, because the worry is people can discern things about the size of your company, number of employees, and so forth. But the judge has ordered that to happen, so it's happening. So year-end tax and accounting. So I'm going to talk about taxes first. I think it's the more important part of the two. So we have a situation where we have two different pieces of guidance here. The CARES Act said that when the PPP loan is forgiven, it's to be excluded from gross income. However, then, and that was March 27th, about a month later, the IRS issued this notice, 2020-32, that said, basically that when there's activities associated with a class of tax exempt income, so that being a loan forgiveness, that even though, because that income is excludable, that the IRS's position is that those deductions associated with the spending of that money are disallowed. So they particularly addressed this question related to PPP loans and said for the amount of any payment of an eligible payment eligible under 1106, which is the PPP program, those costs are not tax deductible. And the IRS's view of this is that by them stating this, it prevents a double tax benefit, meaning that you got the income, but you also deducted the expenses. So that's the IRS's point of view. I have to say that so the effect of this, though, is that it basically makes the loan taxable, because to the extent that you spent the money on the allowable costs and they're not deductible, it basically has the same effect. So I don't personally agree with the IRS, but I don't know that they're listening to what I think. My hope has been that this will get fixed by Congress. But to this point, in November, this is what exists today. So, at this stage of the game, coming into the end of the year, I think the only rational position for now in terms of planning is to assume that the costs that the money was spent on are not going to be tax deductible. So the problem with this ambiguity is it creates a phantom income situation. You are going to be in a situation where under the CARES Act, you were instructed to spend 100% of the funds on allowable costs in order to be forgiven. SBA didn't tell us to spend 60% of the funds and keep 40 for taxes. They told us to spend 100%. So the problem is that a lot of borrowers, not a lot, all borrowers now have a situation where the loan proceeds have actually been spent on payroll and other allowable costs, and now they're going to have to come up with the taxes on that at the end of the year. This is probably for larger companies that may have access to more resources, and of course it depends on the kind of year you're having, right? If you're having a year where you have losses, this pickup in this non-deductible expenses may not cause you to have a tax bill. But my belief is the smaller borrowers who don't have resources are going to be in a cash bind. So it's something, again, I believe that they should correct, but there's no indication that they are going to do that. I did talk with a tax colleague, and as far as we can tell, there is no language in the bill sitting in Congress that's been argued between the House and the Senate. There's nothing in there that addresses this issue. So important right now is you should be quantifying this effect, and you should be in touch with your tax advisor to plan for it as you come into the end of the year. So there's a couple of issues related to that, and this is very ambiguous, which is the timing of the reporting of the non-deductible expenses. So the IRS at this stage, while they said they're non-deductible, they did not instruct on exactly how to handle that in terms of timing. So on one hand, you pay the money, for most companies are going to pay the money, in fact, all are going to pay the money in 2020 and likely not receive loan forgiveness until 2021. Well, if forgiveness is the reason it becomes taxable, is it something that you should, the income should be picked up in 2021 or in the year that you pay the expenses? So that is, if they don't correct it at a minimum, we're hoping that they give guidance to taxpayers on how you address this issue on your taxes, which is, if it's, or is it in the year when the costs are paid, or is it in the year when the loan is forgiven? So of course, there's a whole host of other issues which have to do with if you receive forgiveness after the year end, but before you file your tax return, in terms of the timing of the effect of that. Will if they don't give guidance, will it cause people to have to file amended tax returns? What is the timing? As many of you know, you have to pay your taxes ratably during the year. Well, this has been so blurry and fuzzy, and you don't get forgiveness until next year. Does it have penalties and interest consequences? We don't know that. And lastly, just note that state and local tax authorities have not commented on any of this. So there's still, even though we are hopeful that they correct this, the reality of today, they have not. And there's still a lot of ambiguity around when and what year it affects. So here's some commentary on timing of payment and some options related to it. Excuse me. We've been talking with a lot of our clients about this approach, which is, what effect does this have if the amount of your PPP loan in the form of the expenses are not tax deductible? Well, when do you attempt to pay that money in? Do you pay it in now in quarterly payments? Do you wait until next year? We just don't know, but a strategy to give yourself a little bit of a hedge is that if you are unsure at this point, but it could be that you have to pay this money in 2020, one thing that many people are doing is putting it into their 2020 estimates and maybe their extension, awaiting the ability to understand exactly how the IRS is going to instruct. If you pay it in 2020 and the IRS says, well, that's when the expenses are non-deductible, then you've had the taxes paid in the year that they're asking. On the other hand, if they come back and say, well, you don't have to pay that tax in until 2021, if you paid it in 2020, you at least can take that money that is paid into your tax return, and when you file your return, you can then, instead of receiving that refund, you can just roll over those payments to credit towards your 2021 tax bill. So we're so unsure about how to do it. We're offering these various options, and many sort of hedge position, which is, pay it in earlier so that you have the ability to know whether you apply it now or later. That's more in your control after we get more guidance. And by the way, if we get to the end of this and somewhere along the way they come back and say they reverse this whole thing, the fact that you've paid the money in, you don't need to roll it forward, you can get a refund. So that's a way to, because if there's potential penalties and interest, if you pay in a little bit early, you can prevent some of that. A few other tax considerations just to mention, and I'm not going to go into detail here, but if these costs are going to be non-deductible, they could affect other calculations in your tax return, like NOL carry forwards, those of you that do R&D credits, The section 199, which is the pass-through deduction, could affect that, and also your percentage completion accounting. So these are granular details. You want to be in touch, though. The point, I guess, at this stage is you want to be way ahead of this with your tax advisor so that you understand and consider these things. And at least, you don't necessarily have to go down the road that I expressed in the slides here, but you should have a strategy about how you're going to go at this. With many clients, what we're doing is trying to quantify sort of an if then scenario and calculate, what the penalties could look like, or, underpayment issues, and just try to get that onto a spreadsheet and sit with the client to kind of work through, well, if we go this route, this is the cost. If we go this route, this is the cost. And of course, the overriding consideration is how the company's doing. That's the biggest issue with whether to pay this money in sooner or later. So a lot of loose ends here. The point of this is to get ahead of it with your advisor before year end.
Hey, Mario, before you move on, there's a couple tax questions that came in. Someone asked if we believe the SBA will be sending any tax documentation to the IRS or states about the loan forgiveness amount.
That I don't know, Kevin. It's unclear. I would say that your tax preparer is going to know what those numbers are. They'll base it off of your application, but I don't know if there's any information sharing.
Okay. And then someone said, why not just pay the safe harbor amount? I think that you're kind of saying if you're able to, that's probably the smart thing to do.
Yeah, that's the hedge strategy, is to pay in early, make sure you're safe harbored, know what's coming later. I mean, I said to pay the amounts in this year. Of course, that's case specific. If your safe harbor is low enough, you don't need to pay more than that in this year, but just know that you want to set those funds aside. So yeah, it's case dependent, but you want to, what most of our clients are doing is making sure that they have their bases covered in the current year. And if they're not paying it all in because of safe harbor, they're at least setting those funds aside because they know they're going to be due, when they file their returns.
Thank you.
Okay. On the accounting side, this is pretty straightforward, but there's a little bit of variation here. So the AICPA issued a Q&A, which is a non-authoritative statement. It's not GAAP. It's just a sort of a commentary. And they offered two options here. The first option is what I would say you're going to be seeing 99.99% of the time, which is on your financial statements, you should record the loan as a debt on your balance sheet, and it will remain a loan until you're notified that the loan is forgiven from the SBA. At that point, the loan is written off the balance sheet and it gets recorded as other income in the year that you're notified. So you'd want to accrue interest on the loan through the end of the year as part of your accounting. This approach is what just about everyone is recommending. This Q&A did refer to another way to think about it, which is to recognize the income ratably as the costs are incurred. This is sort of a section borrowed from not-for-profit accounting, because there really isn't any grant accounting literature for private companies as opposed to not-for-profits. And so they sort of borrowed some of the not-for-profit commentary and said, if the loan forgiveness is probable, then you could think about sort of putting it into income as you spend the costs. It's not a recommended approach. And the belief among professionals and accounting firms here that this probable threshold is fairly significant. And so I also would say that I don't believe that that's what most lenders want to see. I think they'd like to see, debt is debt until it's forgiven. There is an issue in number 3 here, that what if you have the loan on your balance sheet at the end of the year, but it's forgiven after the balance sheet, but before the financial statements are issued. So suppose the loan's forgiven in February, you issue your financial statements in March. There's a lot of debate going on about this in the AICPA and the professional community. It looks as though the leaning on this is going to be that if a loan remains a loan until the loan is not, which means it gets put into income at the point that it's forgiven. So I think the present leaning, although I don't think that we have a clear answer, is that if you're forgiven after the fact, you're likely to leave your financial statements the way they are with a loan booked at the end of the year. But there's going to be something more definitive out about that. So we're going to talk about the loan necessity questionnaire. There's quite a number of slides here, but I did one for each of the questions. Many of them are not going to apply to most of you. So we'll move through this pretty quickly, but I'll begin with where we left off with this discussion, which was, believe it or not, April 23rd, when they issued this FAQ that expanded on what was in the CARES Act, which basically said, look, to get this loan, current economic uncertainty makes a loan request necessary to support the ongoing operations of the applicant. That was a standard, very low bar. It was intended to get money out to the market quickly. And the other important thing is it was based on, economic need at the time of the loan application. They also then expanded to say, look, you got to take into account current business activity and other sources of liquidity. So we have had nothing since April. We've commented. In fact, I think I did another presentation about, okay, well, how do you prepare for this? What kind of documentation should you have? And we've been waiting this whole time for them to give us something definitive. Well, that's what they did a few weeks ago, which is what we're going to talk about. So on October 26th, they issued this PPP loan necessity questionnaire. It's form 3509 for a for-profit company. For not-for-profit, it's 3510. It was issued on the 26th, and it's been issued, and it's available for public comment until November 25th. So they gave 30 days for the public to comment on this form. I'm going to suggest to you that I'll go through these slides, but it's very important, I think, to comment or be in touch with your trade association, because I don't think this form is going to be friendly to borrowers. It applies to borrowers over $2 million in loans. But what's important here is that, we've been commenting on what we read back in April about how to prepare for it. If this is fully implemented, this is going to be authoritative. Like, this is what's going to be the basis to determine whether you're eligible for a loan or not. So you want to pay very close attention to this form and how it progresses after this November 25th date. Note that the SBA also says on this form that they can request additional information than what is in the form. It's very important to note that the instructions on this form give the borrower only 10 business days to reply after you receive the form from your bank. The key, though, is that we do not yet know what is going to prompt the lender to send you this form once it's approved. Remember, today it is not an approved form yet. Once it becomes approved, you have 10 days to respond. What we're hoping for is that form would not be given to you and you asked to respond within 10 days until you submit your forgiveness application. That's what common sense would suggest. But this wouldn't be the first time in this whole episode on the PPP that these guys didn't behave in a common sense way, that being the SBA. So, we don't know, but you need to be aware of the fact that there is a 10-day deadline. And so the content on this form you want to be on top of in case it shows up on your desk when you're not expecting it. It has 21 questions in it in 2 sections, one on that business activity that I referred to earlier and one on liquidity. So the overview is this is the way the SBA is implementing the CARES Act rules related to who's eligible. And it applies only to borrowers of 2 million or greater. So if you have a loan below 2 million, the law today says that it's been considered that you've acted in good faith in applying. This form asks for very specific and very limited information, which we don't think is fair. In order to make such an important assessment, it is the truest form of a Monday morning quarterback sort of a situation where this was intended to be what the situation was in the middle of the pandemic when you applied, and now they're bringing bright line testing backwards and looking backwards to see whether your results were such that you qualified for this. So we think it's really not fair. It doesn't address uncertainty at all. It only addresses activity. For every question, there's a confidentiality box to check whether you want your information to remain confidential. I would certainly check that box, particularly in light of this recent ruling. You wouldn't want any more information about your company to be available to any third parties. There are a few places to give additional information, but you're limited to 1,000 written characters, which again, we don't think is very fair. And it does separate private companies from public and foreign owned, like there's some questions in there that won't apply to most of you. And so we don't know whether those questions are in there that are going to be designed to help a private company or not. So it's very unclear to us. My view of this form, I've been studying this thing for 2 weeks, trying to figure it out. We're talking to other people. I've talked to banks. I've talked to other advisors. The way that this thing is worded and positioned right now, it looks to me like they're trying to find more reasons to make people ineligible for these loans. Because I don't think that it's consistent with the CARES Act. So with my clients, what I'm suggesting to them is that today, based on what's in front of us, if I'm doing cash planning, and I'm planning my cash flows for the company, I'm sort of setting this aside to say, I may need to send this money back because this thing is not going to be, it's unclear as to how they're going to do it, but I don't think it's going to make it easier. So my clients, what I'm telling them is, you may need to plan to send this money back in your cash flows. I'm going to go to some of the questions now. So in the business activity assessment, there's 8 questions. There's some that aren't terribly important, but a few that are. So here's the first one that I don't think is consistent with the CARES Act. They're asking for the borrower's gross revenues from the calendar quarter of Q2 this year versus last year. And you have to provide documentation for it. I mean, the standard of applying for the loan, you didn't know what the quarter was going to be looking like. You had a great deal of uncertainty. And yet now they're coming back with a bright line test to say, well, we want to see what happened after the fact. Well, this is the complete Monday morning quarterback situation in my view. And I don't think it's fair based on the standards of what people were asked to do at the time. But nonetheless, it is the first question, and you've got to provide documentation for it. Now, there's 4 questions that refer to shutdowns. And those of you who've read some of what we published and some of the other commentary we've made, we've written a lot about how to assemble chronological information from the time that the pandemic happened, the decisions you made, document everything in terms of the effect on your business, the effect on your cash flows, the effect on your workforce, on your plants, on your job sites. And we were pretty clear about making sure that you kept very detailed notes of board meetings and committee meetings and all the things that you were doing to make decisions. Well, here's where that's going to help. The second question is just the ordered shutdown dates. So it's pretty straightforward. When, where were you ordered to shut down, and what are the beginning and end dates of that? And you got to, and what authority caused you to do that? So that's just your ability to comment on what you were required to do. Question 3 is similar, but not completely shut down, but significantly alter. So in this case, there's a bunch of questions as to whether you were required or ordered to significantly alter from the government. And then you provide details here, number of people, if service was restricted indoors. And then you've got this section other, you've got 1,000 characters here. I wouldn't waste that open space to document your situation in terms of the significant alteration of your operation. So use that open space, 1,000 characters wisely. I would not be doing a lot of prose and writing as much as I would be probably doing a lot of bullet points to get as much content in there as I can to describe how significantly altered our operations were. Question 4 is if you voluntarily ceased or reduced operations. So as opposed to being ordered in question number 2, similar type thing, explain why. If you have employees that contacted COVID, if your supply chain was disrupted, there's different categories, and then there's this other category, other. Again, this is where I would use all that information we've been suggesting that you keep, all those detailed notes and records, to document the reasons and what you did to voluntarily reduce or cease operations. Question 5 is similar to 4 in that it's voluntary, but it's altered operations. What did you do to alter things, change? Went to, split their staff in half, and half worked Monday through Wednesday, the other half worked Thursday through Saturday. what are those things that you did to alter your operation in order to try to protect people, and all those things that you did voluntarily. And then at the bottom here, they're asking you to try to approximate, the cash outlays related to that. So again, all that documentation that we've been suggesting, this is where you want to bring it to bear. You can't attach things here, but you do have this space where you can put up to 1,000 characters to document what you did. Number 6 is a question I don't think has anything to do with the requirements to apply for this loan, but nonetheless, this is more sort of Monday morning quarterbacking in my view. They want to know if you began any new capital improvement projects by the end of your loan forgiveness period. So obviously what they're doing here is saying, gee, if you really needed this loan, why did you start this new capital project if you were, strapped for money? So I'm not saying it's necessarily a bad question if somebody needed economic need, but it also is not consistent with anything that was in the CARES Act. By the way, it's new capital improvement projects, not existing. And of course, then you got to supply, roughly the amount of money that you spent on that. Number 7 is just your NAICS code. Number 8, so this is each one of the sections for activity and then the other one for liquidity has a last question that lets you put additional comments in to support your case. And I wouldn't waste the space here. There's only 1,000 characters, which I find to be stunning actually with how complex this is, that you can't attach more documents or you can't do other things. I think the reality of this though is they're trying to get this thing down to something manageable because there's almost 30,000 loans above 2 million. And if they'll never get through them if they don't standardize it. So I would be very strategic with your comments here about the specifics with your business. Again, this goes back to some of what we've written about in terms of documenting the effect in the business, loss of customers, loss of suppliers, canceled orders. You want to be very thoughtful about using these 1,000 characters wisely. So now we're going to talk about the liquidity assessment. I'm going to try to stay on time here. I'm going to move quickly though. So the first question, now at least the good part about this is it's as of, the period of time when you applied for the loan, but they want to know what the balance of your cash and cash equivalents were as of the prior quarter. So for just about everybody, that's going to be March 31st, and you got to provide documentation for that. So they want to know how much cash you owned, which is relevant to liquidity, but it's not the only thing. And the trouble I have with this is they're not asking for enough other information to really know whether, what the relevance of that cash is relative to the size of your company and operations. You're going to need to use those spaces wisely in that other commentary to get there. Another question that's not part of the CARES Act, but it's a little bit of a look back, is they want to know whether the company made any dividends or other capital distributions to the owners during the covered period. So again, they're saying, gee, if you needed this loan, why would you have the ability to take out capital distributions that are for amounts other than taxes? So you're going to need to disclose that, and you're going to need to provide documentation for that. Another one having to do with sort of misuse of funds, this is like another gotcha question, is they want to know whether you've prepaid any debts. Obviously, the logic here is if we have a borrower who says that they have an economic need, why would they be prepaying debts in a time when they're stressed for cash? Again, not a completely unreasonable question. It's just that these things are not what was in the CARES Act in terms of the qualifications for the loan. Here's where I really disagree. They in question 4 and 5 are really kind of the same, except one is you've got to make a listing of any employee that has annualized compensation of greater than $250,000 based on what they were paid during the covered period. So you look at the person's annual comp, and if you've got anybody that's an employee above 250, you have to provide that information in terms of how many, and then you got to provide documentation, which probably is going to mean, names and amounts of the annualized pay. Number 5 is the same thing, but it's just for owners. So again, the obvious point here is, gee, you've got highly compensated people. Why should you, if you can pay yourselves this much, why should you be able to apply for this loan? That's fine, but you didn't say that at the time that the loan was, application process was started. So this is again another, fairly significant look back provision in my view. So now number 6 isn't going to apply to most of us on the call. This just has to do with whether you're a public company. So most of you are going to be no here because it you got to put the market capitalization if you're public. So this would be not affect any of our private clients. Number 7, similarly, this has to do with whether you have more than 20% of your company owned by a public company, which obviously means that you have access to the capital markets. So most of our clients are going to be no here. This one's going to be yes for most of you on the call. This is the only other piece of financial information that they're asking for besides your cash balance, which is the book value of the shareholders' equity as of March 31st. So this is something that you're going to have to complete. So as a private company, they're assessing your liquidity based on 2 metrics, the amount of cash you had in the bank and the book value of the company. Now, how they can reach a conclusion about that, they may have some algorithm or something, but I am access to other sources of liquidity is a much more complex issue. Those of you that are in construction, you have bonding company needs and you got lines of credit and all this other stuff. Well, now I will say it could be that private companies are getting a break here because by checking no to all those other boxes of public ownership and so forth, that they may be really trying to exclude those kinds of borrowers, but I just don't know. Number 9 is not going to apply to most of us, but this again has to do with whether you're owned by another company, meaning that you may have, outside of your company, you may have access to capital by a parent company. Not going to apply to most of us. Number 10 is not going to apply to most of you, and this just has to do with whether you have an investment by private equity, venture capital, or hedge fund. Again, point here being, those kind of companies have different access to capital than the typical company that we work with, where it's not easy to get access to that money. Foreign ownership is number 11. Most of you on the call probably not going to apply to. 12, just as a disclosure as to whether you got any other money through the CARES Act, like the EIDL loan or other things like that, you just have to disclose it, not too much there. And then 13, the last question in the liquidity section just goes back to giving you sort of an open blank section to talk about liquidity, and you only have 1,000 characters. So again, I will tell you, I'm still formulating my thinking about how I'm going to advise people about using these 1,000 characters, but you wouldn't want to waste them. You want to put things in here that build your case, that support your case, and other factual pieces of information that are important to your liquidity situation. So that's where you might draw in a little bit more than other than your cash balance and your book value. Lastly, this form has a separate certification on it, and it's for penalties of perjury and fraud and so forth. So you want to make sure that you're not fluffing these answers, that you're accurate, you use data that's supportable, because you are going to be held accountable to it. Kevin, that's the end of my slides. If we have questions, I'm happy to try to answer them.
Yeah, that's there are a couple, and it's pretty. Thank you for going through that so comprehensively. It's pretty scary, some things are asking you there. So again, just to remind everyone, this is subject to the notice period right now, and more to come on this. So, and I want to reiterate, this only applies to loans over 2 million. There's no indication, Mara, that you've seen that they intend to bring this down to lower level loans at this point?
There's not. The last FAQ related to this, if you have a loan below 2 million, it's assumed that you've acted in good faith. But they also have left the ability to review anyone's loan at any time up to a 6-year period. So if I'm a less than $2 million borrower, and I think the reason they're doing that is that they're not going to go cherry pick and do other things, but there's, with any kind of government stimulus thing, there's always been things that happen after the fact where somebody discovered fraud or abuse, and then they go dive in and unpack a bunch of stuff. So if I'm somebody below 2 million, I'm probably still gonna go through and complete this form with documentation and stick it in my drawer just in case. Like, I wouldn't want to have to figure that out in 5 years. God forbid if somebody came to investigate or whatever, and I had to produce it. So I would probably have that documentation.
Okay, but there's nothing in the comments that suggests that they're thinking that. But like you said, they're going to want to come after you if they find something that doesn't.
That's right.
So it's a good prudence. A couple of questions were about the compensation. The question was, do you take the amount paid in the forgiveness period divided by the number of forgiveness weeks and multiply by 52 to come up with annualized pay?
Yeah, I'm pretty sure. Let me get to that slide. Where are we at here? Yeah, so they're saying this is verbatim, by the way. My slides are verbatim each question, so I didn't alter it at all with my own. So loan forgiveness, borrowers, owners compensated an amount that exceeds on an annualized basis. So yeah, you would take whatever the number of weeks were, whatever the the annualized compensation was during that number of weeks. If it's 8 weeks, take the total, divide by 8, multiply by 52.
Yeah. Okay. Let me see if there's anything else that just came in. What is his thoughts if things will change with how loan is reported? Gut feeling. I'm not sure what that. I'm not sure what that meant. If the person wrote that can clarify that, it'd be great. Someone made a comment that there was some, I think in the press, a little bit of, them providing some kind of waiver for loans below 500,000 or 200,000. Basically, you're dealing with the upper tiers or anything that you've heard on the lower end where they would just do away with the forgiveness application process.
Yeah, there's been some discussion, and I don't think that this has been implemented, but there's been some discussion that if you're a borrower, and I don't remember exactly, if you're a 150,000 or less borrower, you don't even have to send in a forgiveness application form. That's what I've seen discussed, but I don't think that that's been implemented at this point.
Yeah, I don't think I've seen that. Okay. Well, that's it. And Mario, thank you very much. We will send the slides around, and as Mario learns more, we'll share with our members what we learn. This is also being recorded. We'll send a link for recording. So if there's anyone else in your organization that you think knows this, feel free to share that. But again, Mario, we appreciate it. Oh, one final thing. I think we said this back in the summertime. So we worked out with Mario. If any of our members, would like to have, for a fee, Kreischer help them with their loan forgiveness application. Mario has agreed to support our members that way, so you can reach out to me directly, and we can help facilitate that conversation. So, I think the larger your loan gets, the more you want to make sure you're doing this right. And I know Mario and his team are spending a lot of time on this. So, anyone that's interested, please let me know. With that, we're going to close for the day. We will see everybody next week. Thanks again, Mario. Take care.
Thank you. Glad to be with you.